is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of DeFi Decoded. I'm Alex Tapscott here with Andrew Young. This is our first recorded podcast since Liberation Day on Thursday of last week, the day when America was finally going to be freed from the rest of the world. So far, I feel mostly liberated from all of my wealth and most of my capital gains for the past 3.5 years, Andrew. I don't know about you. But yeah, it's kind of, I'm unburdened by what has been, namely the money I used to have. So that's good. So let's get into the discussion. We're very, very fortunate today. We've got basically the perfect person to come on and tell us about what's kind of going on in the market, mainly what the flows are looking like, where people are parking their money, how retail is reacting to this. And we're very lucky to have repeat guest James Seyffart, who's an ETF research analyst at Bloomberg Intelligence and gained worldwide fame for him being basically the axe on all things crypto ETFs all throughout 2024. But he's got more. He contains multitudes. Crypto is actually not even really the full-time thing that they do over there at Bloomberg Intelligence. So James is a really great person to tell us about what's going on in the broader market. Then maybe James, if we have time, we can talk about how this is impacting flows into the crypto asset ETFs, but also what the next sort of 6 to 9 months will look like for new products, discussion around the SEC, the changing tides in the US around crypto, all that good stuff. But first, James, welcome back to the show.
Yeah, thanks for having me. Happy to be here.
Yeah. Okay. So it's been, we're on day, I think, 4 of trading since Trump made his announcement. Big picture, what have you seen in the ETFs?
The ETFs broadly speaking, or the crypto ETFs?
ETFs broadly speaking.
Yeah, I mean, so April 4th, which was the Friday after the announcement, if you one of the things we like to do is you can use a lot of ETFs to gauge what's going on in the market, both via flows and volume and all those things. And right, so Friday, SPY set off a warning signal, I guess, or fear signal for us, trading over $100 billion. So that's the largest ETF in the world. Or actually, no, it's not the largest anymore, but it's the most liquid ETF in the world. And you can go back through the early 2000s, you can see when there was real market turmoil, when things really sparked above $75 billion, and you can inflation adjust it and look at different things. But essentially Friday, it was okay, things are bad, but it wasn't things are in 2020 or 2008 type bad. So I wrote a note basically looking at that on Friday. On Friday, also, what we tend to see when there's real fear, you tend to see volume pick up in these ETFs. You tend to see volume pick up everywhere because everyone's moving their assets around, readjusting risk, what have you. But one of the main ways they do that is via ETFs because they're diversified exposure vehicles, and people can use ETFs to really change the way their portfolio is allocated without trading individual stocks. So when we see this really heightened fear, we tend to see ETFs as a percent of trading volume in the US will spike up. And Friday we went to 38%, which is a pretty high reading. We see those in bouts of market volatility and downtrending markets typically. But when you combined, really high volume, really high percentage of ETFs, and then you also have high VIX values, all those things tend to mean there's some sort of capitulation, huge big market events going on. So all of that was happening on Friday. And then Monday just took that and elevated even more, right? So we had record volume for ETFs on Friday and at $535-ish billion in the US, which obviously is a lot. The prior record was from January 24th, 2022, which is when the Fed decided they were going to start hiking rates and started getting more aggressive. And that was basically the signal that things are about to get crazy. And then on Monday, we just blew that out of the water with almost $650 billion in trading, right? So we went from 46 was the record in 2022 to this past Friday, the record was 535, to then Monday, April 7th, 640. So everything is blown out of the water. We saw also ETFs as a percentage of trading on that day spiked about 43%. To put in perspective, it didn't really get that high during COVID. It didn't during 2022. It peaked around 40%. So another very highly elevated level, right? So no matter how you slice this, 43%, the only time reading I have going back that's higher than that isn't some weird wonky day is November of 2008. So like you have to go all the way back to 2008. The one thing I will say about the 2008 number is the ETF market was much smaller back then. So the fact that it hit 45%, yeah, exactly. The fact that it hit 45% is insane. But like this is pretty much the second highest level we've ever recorded on that metric that we maintain. So I mean, no matter how you slice it, things are crazy. Like it's off. It's I won't say fully off the charts, but and VIX hit 60 in the morning on Monday. So again, another extremely elevated level. And these types of readings, 9 times out of 10, going back the last 20 plus years, tend to be forming around bottoms, whether it's within the next couple of weeks or months. Like it forms around these capitulation events. The two exceptions there were the one I just talked about in 2022, because that was the start of the hiking cycle, which went on for many months after that. We had a negative market, and the other example where it wasn't the end of the capitulation, it was 2008, and we went down another 34% from when we got those types of readings. So yeah, everything is scary, I guess, is the real answer. But we're rebounding today while we're recording this.
It's interesting. I mean, things can bottom and then they can bottom even more, I guess. Like to your point, like we can be in that period where it happens in and around a capitulation point. One of the other things that people are paying attention to is flows. Now, I only looked at it on Friday, I think Thursday actually. It was the day immediately afterwards, and I saw that at least, I think on balance, there were actually sort of it was net neutral, maybe some outflows, correct me if I'm wrong. But one thing I noticed in particular was that QQQ, which is the NASDAQ, I think it's NASDAQ 100 ETF, broad, market gauge for Mag 7 and other tech stocks. It's been, a huge beneficiary of fund flows for many, many years. Actually saw some inflows on that day. And I don't know what's happened since then, but to me, it seems like as much as there are people trading around this because they're not sure, what to do, the retail has been programmed through prior dips, I think, to buy the dip. It's especially with like large cap tech names, it depends on your timeline. You could argue actually, James, that this is from March 2009 till now, basically, that this is kind of the right strategy. The S&P 500, the NASDAQ were at all-time highs in the last, like a couple months ago. And so that strategy is kind of always paid off if you have a long-term enough view. And I think you wrote a report about QQQ and chill, or like VU and chill. Basically, like they're bearish. They think this is bad. They think the market might go lower. But if you actually are saving for retirement, and you really do have a long-term time horizon, then this is a buying opportunity. And so I saw that day one just in the flows. What have we seen since then?
Yeah, so I was part of that note, so I will say my boss, Eric Balchunas, wrote that note, VU and chill. And like the real overall theme from it is like bearish but long. That's what investors and retail investors are doing. That is kind of maybe sort of changed in some regards. But for the most part, we also refer to something in that note as called the Vanguard put, because people are still buying. They're buying the dip, and it's it's not the Fed put quite to that level, but even in 2008, Vanguard took in money every single month during 2008. They're like the only issuer that did that. So like Vanguard type investors tend to just continually allocate no matter what's going on in the environment. When you start seeing outflows across like their products, that's when the world might be ending, which I mean a complete reshaping of the global trade balances and trade order. Maybe that'll do it, but we're not there yet. And like you said, yeah, QQQ took in a bunch of money. A lot of these S&P 500 ETFs took in a bunch of money. Ironically, on Friday, we saw a lot of like significant assets pouring into equities globally, like ETFs globally, and money coming out of bond funds. So people were basically allocating the opposite direction. And if you look at QQQ, they have it has a mini trust. It's a little bit cheaper, QQQM, which is like kind of doing a lot of the similar stuff. But for the most part, money has been pouring in. That said, the Qs, which we view more as a trading vehicle, so Qs and something like SPY, the S&P 500 ETF, those are like immense trading vehicles. So like there are some products that are mostly used by investors for long-term buy and hold, and there's some products that are used heavily by traders, almost as pseudo futures. And I would consider the Qs and the S&P 500 SPY to be in those categories used by traders. So they're way more volatile in what they're being used, because it's not really just retail that is doing that, right? right? So if you look at those ETFs used by buy and hold investors, long-term people that you were talking about, for the most part, money is still continuing coming in, no matter how you slice it. Money's coming in, but we actually saw money come out of those trading vehicles on Monday, April 7th. So money reversed the opposite direction, but we're bouncing now on the 8th pretty well. But I mean, no matter how you slice it, even people I talk to who are extremely tactical in the way that they trade, they were saying that at some point there's going to have to be a bounce, even if we are going lower, like they would have expected some sort of bounce on the way up, on the way down.
Interesting.
Yeah, and then I guess where are these flows mostly going into, right? Like, is it because I saw also gold was also starting to take a bit of a hit as well, and that was kind of one of the favorite sort of Trump hedges. So yeah, I guess like where
else?
What's doing the best, I guess, on a relative basis?
Yeah, I mean, it really is. Equity products are taking in the most money right now. People are buying the dip in equities, and they are overall, like globally speaking, selling some of their bond exposure, which as much of that could have been like rebalancing, because we saw, if you look at like treasury yields and things like that, they collapsed initially, and then yesterday really rallied up. So if you're looking at like bond prices going up, and they could have been just structural rebalances. If there's a bunch of moves this way, I'm going to do one thing or the other. So yeah.
The bond versus equity fund flow is interesting, but maybe a bit limited, James, because with equities, at least, you can have days where ETFs are 30-40% of all equity trading flow, but that can't be true in fixed income. Like, I think like bond ETFs are still probably a smaller percentage of trading volumes and also assets than owning fixed income directly, or mutual funds, or other types of vehicles. Is that an accurate statement?
Yeah, so one thing I would say is also, when I say ETFs as a percent of total trading volume, it's including those fixed income ETFs. So like, because it's everyone like completely yeah, exactly.
It's like in effect, right? Like it's listed like an equity, but the underlying asset can be anything, right? So that would be like gold, fixed income, like anything that's listed like a security on the exchange.
Exactly, 100%. Okay. So basically the way we do it is like there's indices out there that track total dollar volume traded on all the tapes in the US. And then I can aggregate and tell you, I know exactly what all the US ETFs traded, and you can back into what was traded in depending on what asset class. So it's like ETFs versus everything else. And that's basically how we back into that calculation. But the other thing we'd say, like which makes complete sense, is like usually equity makes up, 60+% of the trading volume. The last 2 days where all these things were going off, they were like almost 80% of the trading volume. So equity for ETFs, I mean, so like it's not just that everything's blowing up. And as you would expect, like the equity ETFs are trading a lot more than, HYG or a bond ETF, though HYG specifically is the only bond ETF that was in the top 5 of ETF trading globally that was fixed income the last few days. So people are moving everything around, really. And they're super efficient vehicles. I mean, you guys know as well as anyone, right? Like they're very efficient ways to move risk around in a portfolio. Market makers can efficiently make markets in them using the underlying markets. There's a whole bunch of benefits. These things were built to be trading vehicles. Yes, they tend to be very good long-term buy and hold vehicles because their total cost of ownership tends to be low. Their fees tend to be low, comparatively speaking. But these things were built to be trading vehicles. And these things that I mentioned that we call pseudo futures ETFs, they trade very efficiently, extremely tight spreads, and they're darlings of the investor universe for good reason.
Yeah, interesting. I'm just looking at the HYG. It took a bit of in the last few days. I guess it sort of trades kind of like a hybrid, right? Because on the one hand, rates may be coming down, but on the other hand, credit risks are increasing, and with economic uncertainty.
Yeah, I mean, the one thing we have seen like a hiccup here, like for the most part, all these corporate bond ETFs, they're trading fine. There's no issues with the discounts and premiums, but some of these newer CLO ETFs actually are showing up with some discounts, likely because it's not necessarily 100% due to credit reasons, but probably due to like illiquidity reasons of the underlying assets. Like bank loans specifically are also, it's trading very tightly, but like these vehicles are not as liquid as like an over-the-counter standardized bond. When you're trading, collateralized loan obligations, they're they're not as liquid. So that's the one area of the market where we saw a little bit of stress. But again, it's not anything to write home about for as far as the ETF industry goes and what we look at. Like if you're investing in these things, you kind of understand there's give and take, and ETFs aren't going to be perfect every step of the way. But so far we haven't seen any real like true complete breakdowns in the ETF world that we've been watching. There's some ETNs that based on volatility that had a little weird action, but they're so small and minuscule that it's not even really worth discussing, to be quite frank.
Right. Yeah. So I do want to pivot to the crypto side, but before we do, just looking forward, we're only 4 days of trading into this post announcement world, and your colleagues at Odd Lots, Tracy and Joe have said now multiple times that, like Joe said, basically he thinks this could be the biggest news event of his entire lifetime. And, that would be people, James, you're maybe a little younger than I am, but, those would be, okay, COVID, the great financial crisis, and this. And it's like, of those three things, like what is actually like the biggest thing in terms of what will have the longest term impact on markets, on the economy, on the relationship between nations and so forth. I don't know if you've given any thought to that big question, but I'm curious, going forward, what are some of the key indicators that you guys are watching? You on the ETF desk, obviously, but also just more generally at Bloomberg Intelligence. Like what should people be paying attention to other than announcements and proclamations from politicians and things like that?
Yeah, I mean, I don't think that's hyperbole from Joe. If there's really is a complete reshaping of the global trade balances and how global trade works, then it's not hyperbole. But one kind of hopes that at least there's going to be some sort of, deals being made, and who actually knows exactly how it's going to play out. I won't pretend to be a trade expert. I have a lot of strong opinions about how these tariff rates were calculated and different things like that. And it's kind of one of those things where something probably needed to be done, but this was kind of the shock and awe approach, and you kind of hope they step back, but who actually knows? But as far as you name those three things, 2008 and COVID, even if I talked about SPY absolutely smashing its daily volume record in all of history, even if you inflation adjust it, there's the only two that are higher are like what you just said, 2008 and 2020. Ironically, actually, there was a flash crash in 2015. For those who don't know, that was another day that technically was slightly higher on an inflation-adjusted basis than what we saw yesterday. But again, that's not something that's really huge news story, life-changing type stuff. So yeah, I mean, it's not. I don't think it's hyperbole to put it in that category, and the data kind of shows that it should be talked about in that category because there's a lot of uncertainty around how this is going to shake out, and markets do not like uncertainty.
Yeah,
to say the least.
So within the ETF complex, I'm thinking back to 2008. There was a lot of money market funds broke the buck because it turns out they weren't holding, the kind of paper that they said they were. And the strain of the crisis helped to reveal that underneath some of these different structures, there were some big underlying issues. Do you see anything? You mentioned we talked about CLOs and stuff. Are there any signs of strain that we can maybe identify within the market that we can identify first within ETFs, or is that a corner that because it's regulated, it's generally pretty transparent? That I'm curious what if you see any sort of tea leaves within your pocket of the market.
I mean, nothing yet that we're seeing things actually break down. And the other thing I would say is a good example of something breaking down that actually had good reason for breaking down, and the ETFs were right and the underlying metrics they were compared against was wrong. If you look at HYD, which is a high yield muni ETF, in 2020 that consistently traded beyond a 20% discount. But high yield munis are a very opaque, over the counter traded market. And if you talk to anyone who is trading those muni bonds, we have a muni analyst that I work with, Eric Kazatsky, and I remember talking to him when this whole thing was going on, and he would reach out to people he knows that were trading them, and there was the only answer we were getting back was no bid. Basically, the NAVs, the prices of the bonds that were being reported were NAVs that were stale, and they weren't active or accurate for what was currently going on in the market. So basically, there was no offers or bids for those bonds. So the ETF, yes, it looks like it's trading at a massive discount because the NAV, the price that the bonds should have been worth was at one price, but what you were exchanging them for in the ETF was severely below it. But really what it comes down to is the ETF was the accurate price, because that at that point in time, that's what you could get for the market. And it's kind of like, the way I think about it is like, I don't know if you guys up in Canada have like, do you guys have Zillow up there, or like those things that estimate the value of your home? Like, yeah, if the value of your home is whatever it says and it's on there, right? If it comes down to the actual like trading your house and selling your house, that's the price that matters. Whether or not this estimate is $1 million, if no one's willing to pay more than $800,000 for it that day, that month, whenever you need to sell it, that's what it's worth, right? It kind of goes back to like a lot of the whole things about like PE, like the volatility laundering that goes on in private equity funds and private funds, where they don't actually mark their things to what's going on in the market. So I think ETFs kind of like just make things very specific and apparent to what's going on. That's not to say we can't see something like one of these blow up. The things that I would be watching to blow up are like some of these single stock leverage ETFs. So we have like, MicroStrategy, NVIDIA, these different things. NVIDIA is probably almost too big to really fully blow up, because you need almost a 50% down day in one day. But something like MicroStrategy or some of these other products, Palantir, that have these 2x levered products in them, they're based off of swaps and derivatives and all these other things to kind of generate those daily types of exposure. And if I'm looking for something that's going to break down in the volatility, it would be those things. But honestly, granted, they didn't necessarily provide exactly the exposure they were trying to do, but none of them broke down completely. They all kind of, for the most part, did exactly what you would have expected them to do. Now, from what I've seen, I didn't like really do a deep dive, but nothing really, completely broke in the way that, money market funds broke in 2008.
Yeah. Interesting. Andrew, go ahead.
Oh, no, I do want to pivot to crypto, but I also had one other question. I don't know if you saw there's an ETF that essentially shorts leveraged ETFs to profit from the volatility.
Yeah.
I don't know how big, that's kind of like one of those funny trading strategies that I feel like, when you first get into backtesting your own trading strategies, it's like one of the first things that people, are like, oh, wow, these things, you can short both sides. Obviously, there's all sorts of borrow costs, things like that. Just really quick, just kind of curious on your opinion on, I guess, the trading strategy as well as the ETF.
Yeah. So, I mean, the trading strategy benefits in the fact that, like, the way that those levered products work for the listener, you guys know this, but for the listeners, like, they reset every single day. So if these things are trading sideways and going up and down in very volatile nature, like, you'll get into scenarios like we got with the MicroStrategy ETFs, the 2x long and the 2x short year to date. I haven't checked recently, but just a couple weeks ago, they were both negative. And that's from what I call it volatility decay. There's a whole bunch of different terms you can go out there for, call it rebalancing issues, decay. But the problem is, like, those products, like, they tend to work. But it's almost like it's not quite picking up dollars in front of a steamroller, but like there are times like all it takes is like a really severely trending market, and you can get hurt pretty bad, right? Or you end up in a situation where both of them go down. You end in a situation where both of them are going up, and if you put leverage on that type of trade, it can be dangerous. But I mean, it'll be interesting to see if that ETF actually launches, because like you mentioned, it's not just that, there's also costs to shorting. So like there's a lot of, like, once you do the back test, like it's one of those things where like you look at it and it's like, oh, this should be extremely profitable, and then you're like, oh, I didn't take into the fact that it's going to account the fact that it's going to cost me 5% a year just to short these things, sometimes even way more than that. So it'll be interesting to see how the ETF actually works. It's the Defiance actually filed for that. It's the first time we filed for it, and I was joking that somebody should file for it on the MicroStrategy products, because MicroStrategy is so volatile. It's like a levered play on Bitcoin, which we all know here how like volatile that asset is.
Yeah.
And so it'd be the perfect case for, like, doing that double short. I think Rob or not, actually, I think it was him. Somebody was on one of the podcasts recently basically saying that they were already doing this. They were shorting it themselves. It's hedge funds tend to do it. There's a lot of people out there that tend to do it and give it a shot, but it can go against you in a pretty heavy way.
Yeah.
So pivoting into crypto though. Yeah. So it's been like, I feel like the last time we chatted was before Trump got elected, and
yep,
floodgates have just completely opened on new crypto ETF launches. I can't even count the number at this point. It's like it's crazy, covering wide variety of assets. Everything from sort of leveraged Bitcoin ETFs to ETFs for movement coin, for example, which is an L1 that hasn't even launched yet. To even like meme coin ETFs. Just, I think I even saw a Trump meme coin and Melania meme coin.
You did.
Well, we're seeing her filings, right? So like, it seems like asset managers, James, like the floodgates have opened up for them to like throw spaghetti at the wall. That's what I see it as. Basically, it's like, let's just file for every possible asset that we can, and try out some experimental stuff, and see what sticks. But I did notice that some of the spot Solana ETF filings, they removed staking. Was that right? And so I'm kind of wondering, like, how open-minded can the SEC really be at this stage if they're not even permitting an ETF to stake assets?
Yeah. So
what's really going on? Not to take Andrew's question, but I kind of like just want to know.
I'll start with Andrew and then move to what you were talking about. Like, yeah, I mean, the floodgates have opened. They opened right when Trump was elected. Everyone filed for all this stuff. We have a bunch of dates coming up where they are basically going to be due to potentially launch. We actually had 2x XRP ETF launch in the US. We don't even have a futures market, so that's a complete change, right? So the SEC is going back to like more the way that they like usually handle this stuff. So yeah, it's an opening, but the something like staking or in-kind creation and redemption, I kind of put in the same camp as staking, though there's a lot of other things that need to be sorted out, right? So like, and there needs to be specific rule changes that allow for those things. So the 19B4 is basically to list the spot product for Solana in the same way that we have a Bitcoin and Ethereum ETF. Ethereum would be the more apt example because of staking. So I guess what you're saying here is like, in my mind, it's like they're going to approve the spot products and they're going to do something. They're going to figure out how to handle staking separately, and it will be in regards to any other asset that comes due with staking, right? That's the way it's going to be handled. So I don't think it's necessarily like we're never going to allow this. You need to take staking out. I think it's just more like, let's get this out and we'll work on the staking language afterwards. And that's my base assumption. But I agree with you. I think a lot of this was, people just like filing for whatever they could, testing the SEC's perimeters around what they will and will not allow. Going back to what Andrew was saying, like, yeah, we have a Melania coin that has been filed, a 2x Melania coin, Trump. And I asked the people that some have filed these things, and I've talked to different people, and they're like, no, like if people were going to trade this, we'd want to launch an ETF. So it'll be interesting to see where the SEC will actually draw the line around what's allowed in an ETF and what isn't. We don't know where that line is going to be. I think the line is pushed way away from where it was under Gensler, but at some point they're going to have to draw a line around what makes sense in an ETF wrapper, I think, or they just go full libertarian and be like, well, look, if you want to launch an ETF and people want to trade it, we'll let you launch it, and we're just going to set up the rules and disclosures for you to do that. And if that's the case, we're going to see a whole bunch of ETFs launch that I think are ultimately going to close, and it will be like the spaghetti cannon thing, like we've seen with these leveraged single stock ETFs. Like, they're launching leveraged single stock ETFs on pretty much every stock under the sun, and some of them are just getting no assets, no trading. They're likely going to close in the next short while, but you get one ETF that is extremely successful, like the MicroStrategy ones, like the NVIDIA ones that have billions and billions and billions of dollars in them, and you're charging over 1%. If you're an issuer, that's great, man. Like, I'll throw 50 things at the wall if I can get one thing that gets $10 billion in it, and I can charge over 1% on it, right? Like, so that's what's coming down to, and I think that's where things are going. So the one thing I'm looking forward to is, one, how are they going to handle in-kind, create, redeem? How are they going to handle staking? And where are they going to draw the line is really what it comes down to.
Yeah. Yeah, no doubt. So interesting. Hey, just not to change the subject, on the topic of staking, I don't know if you saw this company Janover that yesterday announced that it was being taken over by a group of ex-Kraken executives, including Marco Santori, and they'd raised $42 million from a few VC firms to basically, their pitch is to be the MicroStrategy for everything else. That's what they said, starting with Solana. So, look, you're very busy. It's kind of a crazy time. I don't know if this one made it into your Twitter feed or not. But like, that's the Cole's notes. And I think basically like their argument is we can we can stake 100%, any staking yield we can compound, that's better than an ETF. And in the marketing materials, they quite explicitly say, like, this is better than an ETF, which is interesting because I always thought MicroStrategy was always talked about itself as like an operating business that had like a treasury strategy of using its balance sheet to buy Bitcoin. This is making the argument more explicit, and that's probably because, you know, the regulatory environment is different now. But I'm just wondering, like, I mean, if you don't know this, we can move on. But I'm wondering if they launched that and kind of anticipating that maybe ETFs wouldn't get staking or wouldn't get full staking for a while, and like so a corporate vehicle that is able to like stake 100% and compound might actually be like a better way for to gather assets and a better way for investors to like deploy into the sector. I don't know if you have any thoughts on that.
So one, did not see that. Completely off my radar, not gonna lie. As you could tell probably from when we were
potatoes compared to the stuff that you're dealing with at the moment.
Yeah. So like crypto is
you would have been on this.
Yeah. When things are quiet, crypto probably eats up to 30 to 40% of what I'm doing at times, particularly when a lot of things are going on crypto, like it was around Trump's election and things like that. So, but this I missed. But I have a few thoughts. One, I mean, you guys have staking in Canada for Ethereum ETFs already. We're going to get them here in the US. The downside is, like you said, you probably can't stake 100%. There are a bunch of service providers that are looking for ways to like eke up however high you can get with like the staking percentage of your assets to eke up those yields. And there's a bunch of like third-party people, I don't even know what to call that. Not really software, but sort of service providers that are trying to do things. I've seen some ETF issuers like acquiring different staking providers to try and get into the staking game. I think it's going to be a huge part of like ETF competition around like how much of the staking yield are you passing on? Are you going to just charge no fees and just take a percentage of cut of the yield that you're getting? There's a whole bunch of ways that you can do this and make these markets profitable. We see it happening in Europe in some regards. But the benefit of like being able to stake 100% as a company, that's great. But like the benefit of an ETF isn't just like getting those assets and getting the yield. The benefit is that creation redemption mechanism that I talked about before with the high yield muni market and the high yield muni ETF. Like the benefit is like they're going to trade with the underlying asset, right? So like you see MicroStrategy trade like some days up when Bitcoin's down and vice versa. Like it's not going to trade exactly like the underlying asset that it has on its treasury balance sheet like you're talking about. So a company that launches this, just like a REIT doesn't track, like a real estate investment trust doesn't exactly track the real estate market, it's subject to a whole bunch of other risks and whims of the equity markets themselves. An ETF, the create redeem process, always forces you to be in line with whatever the active market price of the underlying asset is. So like this company, I'm sure there's going to be benefits of what they're going to do. There's probably going to be able to lean on leveraging things up the way that MicroStrategy has and all that. But like the benefit in ETF is like you can always take the underlying asset and exchange it for the ETF shares or vice versa and get back and forth, and that keeps them in line. A product like what you're talking about, if things are blowing up, like the odds that it's going to be trading anywhere near the value of the underlying asset, like we have plenty of examples throughout history where it doesn't do that. So there are times and use cases, I'm sure, and plenty of people that would love to go that route. But to say like unequivocally that it's going to be better than the way ETFs will ultimately work, I would question that. It's not 100% accurate, I guess I would say.
Interesting. Speaking of premiums and discounts, Grayscale's product suite, again, I don't know if you've taken a look at the website.
Yep.
But like GSOL, for example, a pretty insane chart. If you look at the chart of the NAV versus the unit price.
Yep.
It is insane. So, at one point it was trading at like 600-700% of NAV. So there was like, $14 of NAV and it was like $90 or something. And yesterday I looked at it.
I can share my screen here if you want to use it.
Beautiful. Oh my God. Part of our broadcast. This would be incredible. But like, this is exactly correct. And actually, if you go back one more year, start in 2023, James, there. Okay.
Yep.
So like
crazy.
That's like a crazy Bart Simpson haircut chart, but it's the P to NAV that's doing the trend, right? So right now we're at this point where it's more or less at NAV, but still like, I mean, in regular ETF land, a fund that trades at a 15% premium to NAV would be an insane premium, but not in the crypto world. So this chart just tells me that, Solana ETFs are a matter of like when, not if, and that they're probably coming very soon. Because remember the inverse of this, James, last year, maybe a year and a half ago, when GBTC was, at a 50% discount, and it got up to a 5% discount, 4% discount, and that was basically just the time value between where we were and when it was going to get approved, and that happened, and then it closed, right? So, I mean, it seems like that's what this chart tells me. What does this chart tell you?
Well, wouldn't it? Sorry, just real quick to jump in. Wouldn't that also be potentially because the kind of like the enthusiasm around Solana has kind of gone down quite a bit in the last 2-3 months, or is that not? Or is the divergence purely just sort of people shorting that and buying the spot?
No, I think it's both for sure. I think it's three things. Like probably it's the interest, waxing and waning interest in Solana. There's the fact that, I mean, this massive thing where it falls off a cliff last fall, I think was when one of their huge private placements became free trading and people were able to exit at a premium. But the big one to me is the ETF, are discounting the premium. So James, what do you think?
I think you're 100% correct. I think when you look at the GBTC thing, it was like, what are the odds that this ETF is actually going to be approved? And despite the fact that Eric Balchunas and I were very optimistic and put our odds really high like months before these approvals, the market just didn't believe it. I had plenty of extremely smart people that really thought that the SEC wasn't going to approve Bitcoin ETFs. Up until like the week before the approval happened, where we were like 80+% odds that it was going to get approved. Yeah. So I mean, that's the number one thing here, right? This thing is going to convert into an ETF, and the premium will disappear when that happens, right? So that's the number one thing. I think part of it is what Andrew was saying. Also, there's like SOL has lost a lot of interest in regards to to what it was, but really it comes down to the fact that this thing is going to become an ETF, and market participants sniffed it out, and we're dumping it because it was trading at too much of a premium.
Yeah.
So one thing I also really want to ask, I know you sort of before the pod said you've been focusing obviously more on the macro side for the last week, but I'm just kind of curious, one of the narratives going across the weekend was how well Bitcoin has held up. And we already talked about how gold has performed quite well on a relative scale. I'm just kind of curious, like what's the institutional market saying about Bitcoin right now during this huge story of potential end of or restructuring of global trade, like that? Logically, that should benefit Bitcoin. I'm just kind of curious if the sort of institutional investor class is seeing that narrative, or if it's just kind of like, let's focus on not dying in the next kind of week.
Yeah, I mean, what it comes down to, last week, the huge talk, and I even was one of the people looking at it because I was shocked at the actual decoupling of risk. So basically, usually Bitcoin for the last few years at least has been rather highly correlated to something like the NASDAQ, right? As risk assets went down, it went down. As risk assets went up, it went up, usually in either direction. But the last few weeks, that kind of broke down at different times. And last week was the biggest, where it was actually going up while everything was going down, including gold. Gold was down and Bitcoin was up. It was very weird. A lot of people were looking at it, trying to figure why. Was it because GameStop was buying and Saylor was buying, and who knows? And that turns out not to have been the case. But that, brief respite of like outperforming and holding on kind of died down on Sunday evening. Bitcoin started collapsing under 80K. Now we're still under 80K at the time of recording. The one thing I will say is, it's down pretty bad. If you look at like since risk assets started falling, it's roughly in line. It's like 20%-ish down alongside the NASDAQ, and the Magnificent Seven's down like 26%, or it was before today. So they're all up a little bit now, and Bitcoin was like trading mostly in line with those assets. That said, they're way higher off the peak, which makes sense. Bitcoin is way more volatile. But if you had told me what happened over the last few days and given me a heads up a month and a half ago, I would have assumed Bitcoin was trading in the 60s, maybe even lower. So comparatively speaking, my view is like it's actually held up kind of well compared to what it usually does as like almost like a leverage risk asset. It's trades on liquidity, it trades on all these things. So the flip side of this that I would say is like, obviously Bitcoin's been going down for a while now. All crypto for the most part has. But it's like, it's trading. the opposite direction of where all the fundamentals are heading, right? Like I've been to a few conferences since all this started happening. And like, I'm talking to people in the space, I'm talking to ETF issuers like you guys, I'm talking to, you name it, a whole bunch of different institutions in the space looking to get in the space. And they are like more bullish than I've ever like had these conversations. There's a lot of things to looking forward to. It basically, these headwinds from the Biden administration, Gary Gensler, the SEC, you name it, any choke point 2.0, all these things, these headwinds are turning to tailwinds, or at least the headwinds are mostly gone, and still the price is going down. So like, it's this weird dichotomy of like, risk assets are down, everything's going down, crypto's going down, but like the underlying, if you want to call it fundamentals, or the underlying backdrop of what's changing, it's actually like, this should be tailwinds. Like, you'd expect things to go well. And I kind of, one argument is that Bitcoin like front ran those changes right after the Trump election, because everybody was super optimistic. But when you talk to people, institutions, it's like, everybody I talk to is like really looking forward to this. And honestly, a lot of people who are like thinking about getting in, these advisors, one of the huge things in the US and globally is like, do advisors recommend them? Are they putting this type of stuff in client accounts? And they couldn't. And it's really that those wheels are really starting to turn around allowing these different platforms, these wirehouses, to put their clients in these products in Bitcoin. So like, there's usually 3 different levels. Either like, you can't touch this no matter what, if you're using our platform. Then there's, if they request to buy it or they meet some other certain criteria, you can buy it for them. And then the final level is like, you can recommend it to a certain list of clients. And a lot of different huge people that control trillions of dollars are getting to the point where they're going to be able to, recommend these things, if not trillions, at least hundreds of billions. So
I feel like the trend that you're describing is also leading to greater Bitcoin dominance vis-a-vis other crypto assets, because frankly, like, advisors can call their clients and make the case for Bitcoin pretty easily. They say, look, this is digital gold. It's being recommended by Larry Fink, and all of these other smart people. It's a store of value. It's uncorrelated. It's as a part of a portfolio. Our model portfolio recommends it. Therefore, we think an allocation is reasonable, right? Like, it doesn't take much. Where it's like, okay, why do I own Ethereum or Solana? It's like, well, it's this platform. I mean, there is a case to be made, and I actually think it's really compelling. It's a compelling investment case, but it doesn't. It's like, well, it's a platform, decentralized applications and peer-to-peer value transfer in digital assets. It's like, what does that mean? Like, I don't know what that means, right? So I can't help but feel like Bitcoin is so far the big beneficiary of this shift in policy, where regulatory headwinds or tailwinds have now become tailwinds. And yes, it's down from inauguration, and yes, in the past 2.5 months it is in line more or less with the Mag 7, but since inauguration, it's still up. And that's not true for stock indices, for example, and it's not true for for all other crypto assets. So there is a bit of Bitcoin exceptionalism that's happening, I think, in the market, even though it's all relative. Like, even though it's still down bad. Like, if you were an average retail investor, and you said, hey, the position's only down 25-30% versus 50%, that's kind of cold comfort for a lot of people. But I can't help but feel like that's like one of the outcomes of this. And then in terms of like the where we're at, yeah, like, to me, the back half of this year is setting up to be insanely bullish for crypto if we can somehow get through this current tariff trade calamity that we're in, right? Like, Circle filed for an IPO. There's a dozen other big companies like it who are in the queue.
Galaxy just filed.
Like
yesterday, I think. Yeah.
There you go. All of these companies are like perfect. So they've all been, a lot of them wanted to go public during the last cycle, missed the boat because the Biden SEC was not super supportive. Now they're going public. There's now going to be a growing investment universe of public issuers with audited financials that are with regular reporting. People can dig into it. More fund managers are going to own those names. More fund managers and advisors are going to get exposure to, Bitcoin through the ETFs. We're going to get probably a deluge of ETF approvals in crypto, which will be a survival of the fittest game. Some will succeed, some will not, but it's going to mean net flows into those assets, especially since there's no GBTC USD or ETH overhang the way there was the last time. Like we had to churn through the redemptions there. Now we just have to it's all net new creations, right? So like all of those trends to me are setting up for an H2 of 2025 where it's just all bullish. And especially now that even the meme coin mania has fizzled out. And so now there's no nasty, horrible thing that's overhanging crypto. It's just sort of we're primed. But I think it's the tail wagging the dog. Crypto cannot succeed in a world where risk assets are being sold indiscriminately and where investors are fearful, right? I just don't see how those two things go hand in hand. Maybe Bitcoin ends up modestly higher because it decouples. I still am pretty skeptical of that, but I think we still have to get through the current moment if we want any hope of seeing that fulfilled in the next half of this year.
Yeah, I mean, I'd say first, your description of, the Biden SEC not being super supportive is the most generous description of what was happening.
I was told by someone, and I won't say who, to moderate my tone on these podcasts.
Yeah, I'll just leave it at that. It's far worse than that. As far as you were saying about Bitcoin, honestly, before the election, my view was Bitcoin is going to be fine no matter what. It's not doing a lot of these, decentralized finance type of things. They're not trying to replace all these things that the SEC was going after, saying that automatically makes them securities. Bitcoin already wasn't a security. Ethereum, even to some extent, was not really claimed to be a security even by the Biden SEC or Gensler SEC. But I agree with you. I think the pitch for why Ethereum is a lot more complicated than why Bitcoin. And if you had asked me, or even I've said this on our own podcasts, I thought the Trump victory would be more beneficial to these other tail of assets, the Ethereum Solanas of the world, because a lot of the things that they are doing and trying to do are good. The things that were just not allowed under the SEC, CFTC, OCC, everything you name it, they were the ones pushing back. Whereas Bitcoin, digital store value, digital transfer value, done, that they weren't really fighting that for the most part, right? But the benefit, as you said, is just it's way more accepted. The narrative around Bitcoin is very easy to understand. Digital gold, digital store value. I think of it as a call option on a digital store value, right? It's not quite there yet. It's still a risk asset. Could it be someday? Some people say no. I think unequivocally, based on the price, the odds of it happening have increased. Whether or not it happens is a different discussion. But unequivocally, that's what the market has decided. The odds of it happening has gone up. That's my view. So I think all of that and the fact that these different platforms are accepting it and going to start pitching it, it's going to be a while before these other assets. So I think we were very bearish on the amount of assets that Ethereum ETFs were going to get compared to the crypto faithful and the Ethereum people. I mean, compared to the Bitcoin maxis, they said they weren't going to get anything, but we were saying it was going to get a discounted ratio of the market cap ratio of Bitcoin and Ethereum, and we even undershot it because the Ethereum ETF launches here in the US, due to that ETH overhang you were talking about with shares, had net outflows until Trump's election. They had $600 million in outflows. Earlier this year, they were up to $3.2 billion in inflows, but a lot of that has come out again since then in at the end of January, early February. So it's just a harder pitch to make. And if you listen to different people, they'll say it's it should be more akin to if you own the Mag 7, you should have a slice of exposure to something like an Ethereum or Solana or one of these other altcoins that have been filed is the real pitch. But it's not as easy and simple to make as here's why you should have a slug of Bitcoin in your portfolio.
Yeah.
And we're showing, as you said before, the dominance is growing for that reason.
Yeah, for sure, and especially in an environment where gold is doing really well and Mag 7 is struggling. ETH being essentially a crypto Mag 7 is kind of the way some people think about it. One last thing I also was kind of curious your opinion on was the sort of divergence between Coinbase and some other crypto equities versus things like Bitcoin essentially. I was just kind of curious, again, if you can comment, just kind of this, it seems like Bitcoin MicroStrategy, just can't, it's just been outperforming so much over the last 3 to 6 months, whereas these other sort of other sectors of the crypto, TradFi crypto space have just not really gone to bid.
Yeah, I mean, this comes back to like what I was kind of talking about before with like the risks of those other assets out there. Like MicroStrategy is its own animal, I guess. It trades it's leverage play on Bitcoin, right? Coinbase is like, it's almost like an index fund of exposure to the crypto space. I think of it in some ways. Obviously, it's not as simple as that, but that's more so. Whereas MicroStrategy is levered just to Bitcoin, whereas Coinbase is like a much broader play on the entire ecosystem. I would think about it. But the other problem is, I know I said Bitcoin is a risk asset, but like when you do things, when you have a company that's doing a bunch of other stuff and it's in the equity markets, it's the same thing with like real estate investment trusts, and the same thing with these other things I was talking about. Like the underlying value, the value of that stock that it's held is not always, it's not, the market isn't perfectly efficient. It's not going to be, this is the value because this is the discounted cash flows going forward. It kind of gets dragged down or dragged up with the broader risk market. And in this case, I think Coinbase is being dragged down on that front, and time will tell. But I mean, as far as like optimism goes, things have never been more optimistic for them. They're winning court cases left and right, but that doesn't mean necessarily they're going to be, making more money if the entire crypto ecosystem keeps losing value.
Yeah, that's the truth. I mean, the equity complex, that's why I'm most looking forward to this IPO boom, hopefully, when it happens, is because it's going to add a lot more diversity to the investment universe of crypto companies.
100% agreed.
Because right now, it's like Coinbase, the biggest exchange, and also the creator of Base, and they have a portfolio of assets, and they have some crypto on their books. But it's a brokerage, first and foremost. Then you got MicroStrategy, which to your point is a levered Bitcoin play. Then you have the entire mining complex, and there actually are several issuers that are miners, but they're trading now as AI data center options more than they are trading as crypto companies, which is one of the reasons why they've underperformed even Coinbase, Bitcoin, Ether, all of these things, is because the combination of crypto going down plus the DeepSeek news completely took the wind out of the sails of that whole thesis. That's makes people's job challenging if they have to invest in this ecosystem, because where else do you go? Right? So having more options in the market is going to be very good, I think, for just broadening the investor base, because there's going to be more real companies that you can put money into, basically. And I think that's going to help a lot.
I would echo all that, and I would also say that miners, if you look at gold miners, specifically junior gold miners, and these when you get smaller companies, a lot of these Bitcoin miners are, granted, they're not small companies in the grand scale, but when you're talking about equities trading on US markets, they're comparatively very small.
Yeah.
And the way those businesses work, that depending on how big their fixed supply is, their fixed costs are, if you can get larger and larger and larger. So one of the most volatile products in the world was the junior gold miner, the 3 times levered junior gold miners ETF, right? And what that did is it holds a bunch of these smaller miners. And I'm saying this because when I correlate back to Bitcoin, the reason that they're so volatile is because they're so dependent on the underlying price of gold. So if their fixed costs are a certain percentage, and then if the price of gold goes up just a little bit above their cost, their other variable costs, and they're slightly profitable, and then it keeps going up, it's like leveraged earnings for them. And that's the same thing that happens with these Bitcoin mining companies. And I don't know, my personal view is a lot of these companies aren't the greatest businesses in the world. They're completely dependent on one thing, and if your costs, your energy costs go up and things like that, there are huge risks there. And so I think that's also another reason, and a lot of people understand that, and they look at these businesses and they're very capital intensive and all these different things. So I generally do think it's a good thing that they're starting to diversify to be more general purpose, AI computes than just Bitcoin. And I think the best ones will be some combination of those, where if they're not being used for AI compute, you can do something where you use that energy for Bitcoin mining and so on and so forth. But yeah, I'm not obviously a mining analyst, but those are the one things for anyone who's trying to figure this out, why these things are so volatile. They're basically leverage plays, and once it goes over a certain, Bitcoin goes over a certain price, and if a company has a certain cost to mine that Bitcoin, it's leveraged upside exposure for them.
Yeah, no, 100%. And I think, AI and crypto are separate but related technologies in a way. I mean, there's some intersection. You need compute to secure these blockchains, or at least Bitcoin, and you need compute to do all this AI stuff. So it's interesting to see how they'll mature together. James, that was an awesome discussion. Like best of the year so far. We covered a lot of ground, and we used up more time, I think, than we asked of you initially. So we're really grateful for that. And we hope to have you again during hopefully quieter times when you're able to expound even more on the crypto space. But those general market insights were enormously valuable. I'm sure all of our listeners will really benefit from your perspective. So thank you. Appreciate it.
Yeah, thanks for having me. I'm going to assume you saying it was the best of the year is an exaggeration, but I appreciate it nonetheless.
Well, it's only been 3 months. So best of the year so far. We'll do our
Appreciate that.
Yeah. We'll do our best of list at the end of the year. But yeah, best of the year so far.
Yeah. I mean, also, it's an exciting time right now, so there's a lot to talk about. We could have just kept going for 2 more hours.
You're actually the perfect guest for this particular week. We're really glad we had this and not, some crypto founder talking about his new consensus mechanism. No, those guys, we love those people, but this is great.
There's a time and a place, yeah.
Yeah, it's time and a place, yeah. That's it for this week's episode of DeFi Decoded. I'm Alex Tapscott here with Andrew Young. Make sure to rate, review, and share the podcast. Helps other people find it. Till next week, take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.